Last Friday, the first trading day of 2026, the spot gold market staged a roller coaster-like volatile session. It opened higher in early Asian trading and continued to climb, breaking through the $4,400 integer level at one point with a maximum intraday gain of 1.89%. Exciting to watch. However, the good times didn't last long. Concentrated profit-taking triggered a sharp price drop in the session, but fortunately, the decline narrowed gradually in the late session, eventually closing at $4,328.70, a slight increase of 0.20%. It fell for 0.51% this week, finally ending the intense volatility on the first trading day of the year. This high-level volatility reflects both the long-term bullish support for gold and exposes short-term market divergences and profit-taking pressure. We really need to keep an eye on the New Year's trend. The strong pull-up after the opening was actually driven by the resonance of three core factors. First, expectations for Fed easing have strengthened. The 2025 interest rate cutting cycle has extended into 2026, and the market generally predicts at least 3 interest rate cuts this year. The decline in real interest rates has directly reduced the opportunity cost of holding gold, which can be described as the core driver of gold price gains. Second, global geopolitical risks continue to heat up. Conflicts in the Middle East and Asia-Pacific regions showed signs of escalation at the start of the new year, and safe haven funds flocked into the gold market, directly boosting prices to climb rapidly. Third, the demand for New Year's capital allocation was released centrally, and the global central bank gold buying spree has not stopped. Global central banks net bought more than 1,200 tons of gold in 2025, and the People's Bank of China has increased its holdings for 14 consecutive months. Coupled with the repositioning of institutional funds at the beginning of the year, it provided extremely solid support for gold prices. As for the intraday plunge, it was caused by the combination of profit-taking and short-term bearish signals. On the one hand, the cumulative gain of gold in the early stages was really huge, with a large amount of profit-taking accumulated near the $4,400 level. Once it reached the high, institutions took profits accordingly, triggering program trading to follow suit and sell, directly exacerbating the price decline. On the other hand, expectations for Fed interest rate cuts have undergone subtle changes. The latest U.S. employment data shows that the labor market is still resilient. The number of initial jobless claims in the week ending December 20th, 2025 fell to 199,000, lower than market expectations, leading to the probability of the Fed cutting interest rates by 25 basis points in January 2026, dropping to 16.1%, which temporarily suppressed the trend of precious metal prices. The World Gold Council also stated that if the U.S. economy experiences a mild downturn and the Fed accelerates the pace of interest rate cuts, gold prices may gain an additional 5% minus 15% upside space, and the long-term potential is quite promising. In addition, as the Spring Festival consumption peak season approaches, the gold market enthusiasm is likely to continue. But no matter how good the trend is, we must view it rationally and do a good job in risk management first. All content above is for reference only and does not constitute any investment advice. Any trading operations conducted based on this information are at your own risk of profit or loss. Want to get real-time gold price trends, technical analysis, and major market news as soon as possible? Subscribe, like, and share with your investment friends around you now. Thanks for watching. Wish everyone a smooth investment in 2026.